edition of the CLBA webinar series. We got two great presentations lined up for you today. But before we get on that, I just want to do a little housekeeping. This is the last day for the early bird special. Save yourself $200. Register by 5 p.m. this afternoon. Get yourself your room block also, which is discounted a couple $100 too. Other than that, we have a really great lineup for you at the conference this year. We have some other surprise speakers we're going to be announcing shortly. So keep your eyes open and ears open. We'll have some good things going on. But before we get to that other stuff, I'm going to introduce Martin from Express Capital Financing. They're going to do a great presentation for you on Express, what these guys do. I know they're continually growing and they got a lot of good stuff going on over Express. I will have this recorded, so if you guys want a copy of it, just send me a text message or an email. I'll make sure you get a copy of the recording. Martin, I'm going to turn it over to you, sir. If there's any questions, do you want me to interrupt or hold them to the end?
Yeah, maybe hold them to the end. This way I could do it properly and effectively.
Excellent. Go right ahead, sir. The floor is all yours.
Appreciate that. Thank you, Scott, and the CLBA team for having this webinar out there. So my name is Martin Chera. I'm the president and owner of Express Capital. As you see on the screen, that's my son, Max. We've been around. We're a father and a two-son team. We've been around for about 14 years. We started out as kind of brokers. Now I'm happy to say out of the 14 years, the last 9 or 10, we became direct lenders. We opened up recently a wholesale branch, which is called OLV. We call it Olive, but it's OLV, which is our wholesale lending platform for DSCR brokers. But I'm going to go into the wholesale, the retail, what we do, what we don't like, and all that. So just a quick recap, 14 years of business. The last 9 or 10 were direct lenders, father and two-son team. We got about 15 loan officers, about 30 underwriters and processors. We'd like to work with brokers that know the deal, how we can help them, price them out, and work effectively. So everybody wants the best pricing, but we understand that communication is the key to success on every broker deal. So with that, appreciate your time, and I'm ready to get started. So who we are, like I said, 14 years in business. Our loan products are fix and flip as a nationwide direct lender. We do ground up construction on 1 to 4 unit properties, as well as multifamily and mixed use. And we do DSCR light dock on 1 to 4. And we also do light dock retail DSCR on commercial properties. I'm going to give you a closer look at each of the one of the programs and how we work with brokers. It's a two-way partnership. Communication is the key to success, like I said before, state of the market and where the volume is going. So we are a nationwide asset-based lender, just about 3 or 4 states we don't lend in, North Dakota, South Dakota, I think maybe Hawaii and California are the 4 states. We're family operated. Relationships are first. Fast decisions, never holding you in queue. We will answer your deal submissions, whether it's a phone call, an email, however you're sending it, the same day. We got 2 offices, Brooklyn, New York, and West Long Branch, New Jersey. So, and we're also looking to open up a shop in hopefully Texas and Florida within the next 6 months. If anybody has any thoughts on joining the team and branching out with us, we would like to talk about that as well too. So we funded over $1 billion in the past 9 out of the 14 years. And not to repeat myself, but we are a nationwide footprint. By the way, we pride ourselves on not just answering the submissions and answering the phone calls. We pride ourselves on, which is the first box on the left, customized solutions. We work and try our best to make it fit and to get to a say yes. So we have programs and products built around every deal. We don't have a rigid guideline box. So meaning we can work with borrowers sometimes with the lowest score, or if we want to add on a ghost borrower, such as a family member, to increase the leverage, to get a better rate, we can hopefully work around those type of things. But with very customized solutions to work around the deal specifics to hopefully get to a yes, which is a pass. Simple, effortless process, streamlined from the application to funding. And any wholesale brokers, we will give you access to the portal where you could directly price out your deals yourself. Of course, if you have any questions, How do I get a better rate? How do I get a better leverage? We're here to answer your questions, but the portal is there to give you everything from proof of funds, term sheets, all types of scenarios, higher leverage, lower leverage, different types of prepayment structures. Of course, I'm just talking about right now the White Doc DSCR. Investor focused partnership, we like to win where our borrower wins. Expert guidance, like I said, we're here to answer your questions, concerns on anything because we understand that building your pipeline of prospects is very important. So we're here to answer your questions on any deal specifics. Our loan products, fix and flips as a nationwide lender, we could typically go up to 90% of the purchase, 100% of the renovations, up to 75% after repair value, ARV, 12 months, interest only. We could also do, case by case. We could, entertain 100% financing for very strong sponsors, strong deals. And when I say strong deals, strong economics. The profits, the ROIs are there. So we got a strong borrower, strong economics. Then we would entertain 100% financing. On the ground up construction, new builds, we could do, like I said previously, 1 to 4 units, multifamily, and mixed use. Just a quick matrix on the ground up, we could go up to 75% of the acquisition, 100% of the ground up, 12 months, interest only. Rates right now are a little bit, slightly higher than the normal fix and flips. They're probably going to be in that 10 to 11% rate. However, like I said, interest only, no prepay. It's as dispersed, so you're only paying on the used funds only. On the DSCR, I'm sure everybody knows what that is, debt service coverage ratio, rental loans, no tax returns, no W-2s, no income verification. The good thing also on our DSCR, we can do both ways under an entity and under a person's personal name. If you're going to bring us a deal under your client's own name, we just cannot wholesale the deal under our olive branch. And I'll go through the differences with you in a few moments. But basically, on our DSCR, we got so many choices for the clients to choose, from prepay as high as a 5% over 5 years to as low as 1% and even as low as 0%. Of course, the lower the prepay, the higher the rate. But the good thing is to know we have those options. On the DSCR, we also have interest only for 10 years, and it's an amortized loan over 40 years. So for the next 30 years, it would be interest, principal interest, and taxes and insurance. The first 10 years, it would be an interest only. On the DSCR portfolio, as long as you got, it says 2 to 10 properties, but the way we do portfolios, even if you have, let's say, 100 properties, to us, it would be a 10 portfolio loan product. We could just do only 10 at a time, but we could do 100 or 200, properties in a particular portfolio. Similar to the DSCR, as far as leverage is concerned and as far as rates are concerned, which I'm going to go into. On the bottom box, it shows like a little house or a building. On the fix and flips or bridge, hard money, we also could do a multifamily and a mixed use. We want a 250 minimum loan amount, 75 max LTV, 100% of the rehab or CapEx, as long as it doesn't exceed 70% of after repair value, and the loan to cost, we typically want to be around 80 to 85%. So just to recap on the bridge, we could do 1 to 4s, multifamily, mixed use. Scores, we typically, we'd like to have a 650, 660, but we're not credit driven. If you remember what I said earlier, we don't have an exact matrix or box. We don't have a formal guidelines. So if your borrower's got a 600 score, a 650, a 640, we could definitely fund it, entertain it. The way we would do it, we would just ask for something that's called interest reserves to mitigate risk on the loan. Are we going to take any newbie on a loan with a low score? No. So a 600 score would be our minimum for a person that has, 5+ deals. A person coming in brand new, we typically want like a 660, maybe a 680 score. But there's ways to work around it. When you call me, I'll tell you, but just to give you a quick snippet, maybe we could bring on a spouse, a child, a partner to have a higher score, and also to get more leverage if the deal merits that. So that's it as far as bridge, fix and flip, 1 to 4s, multifamily mixed use, ground up, 1 to 4s, and multifamily and mixed use as far as that's concerned. Okay, so like I said before, we could do 90% of the purchase and also 90% loan to cost. For all the brokers who are not familiar what that means, take the total project, which is the purchase price, and the rehab. That is a definition for loan to cost. Our loan to cost max is typically, actually it's 92.5%. So we could go as high as that. So that's a little bit old at 90%. And how do you get to 92.5%? When you have a low purchase price and a high rehab, you're typically going to be 90 or higher on the loan to cost, and we can max out at 92.5%. 75% ARV we could definitely do. The rates are a little bit different. This is an old spreadsheet. So the rates right now are anywhere from 9 to 10s. Maybe a new borrower would be in that 11% range. So I'm going to say like 9 to 11, but strategically we could be in that 9 to 10%. Interest only, no prepayment penalty, and only paying for what they use. Can we do longer than 12 months? Of course, if the deal merits it, where it's a high rehab, it's on the East Coast, you got some bad weather coming up, we could do anywhere up to 36 months. It's a conversation to have, and we can work around that. On the right side, like I said before, we're not credit sensitive. However, we don't want to do a hard money bridge lower than a 600, but we can work with borrowers in the 600 plus scores. So we underwrite more about not even more, we underwrite the deal. The borrower score is just to know the character of the borrower, who they are, and how are they, are they, I don't want to say the word trustworthy, but are they a good character trait where they're going to pay back the loan? As far as the draws are concerned, we have unlimited draws, and we can do the draw payments in 1 day. It's on a phone app, and they take the photos. The old-fashioned way is the inspector has to come within a few days. The lender gets back the report in a few days. Now it's just a quick snap on your phone, and you get your wire in 1 day. What that does for your borrowers, and this is something that you should be telling your borrowers, yes, it's quick, yes, it's easy, great, but really what it does, it gets them out of the deal faster. The faster they get the money on the draws, they pay their contractor quicker, and what does that do for them? They're out of the deal quicker. It saves them on the carrying cost, which is insurance, the payment every month to the lender, and also taxes on the property. So if they're out of the property quicker because they got their draw money quicker, they paid their contractor quicker, their carrying costs are reduced, and their profits are greater. So this is really the emphasis that I emphasize on the easy photo draws. Fast closings, we can close a deal in as quickly as 3 days from title and appraisal. Typical turnaround time from start to finish, 7 days, 10 days. It really just depends on the borrower, how quickly they want to move. So if you got a deal that wants to close 7, 8, 9, 10 days, we will put a rush on it, and we will do everything possible to make it happen. Ground up construction, we only want to do land and vertical. So vertical means, for everybody on this podcast, we don't want to do horizontal, which is going sideways. We want to go upwards. And we want the property to be shovel ready with permits. The good thing is here, we can go up to 90% loan to cost, not loan to value, loan to cost. And again, you take the project, which is the purchase price of the land, the vertical ground up budget, take that total, and we can go up to 90%, which would give them the max leverage possible. Typical terms on a ground up construction, even though I'm showing you 90% loan to cost, with permits and plans would be 75% of the acquisition, 100% of the ground up, 12 months, interest only, and rates are right now in that 10 to 11% range. We do want a score of a 680 minimum on the ground up. So we want a person that has experience of at least one deal, and we do want a 680 on a ground up deal. And this is strictly what I'm telling you right now. I shouldn't say strictly. So This is for 1-4s or multifamilies or mixed use. That 12 months interest only, again, it could be stretched out if we have a good explanation. 24, 36 months, no worries. Same thing with the draws, unlimited, and it's a 1 day draw expense. This particular product, ground up, is dependent on experience. We definitely need to have 1 month, one completed deal done. A lot of brokers and clients come to me and they say, but the contractor is an experienced contractor. Does that help? Unfortunately, we want the experience to be on the deal. So a contractor with experience, if he's just a contractor, that doesn't help. But if he's coming on the deal, becoming a guarantor, that helps. So if you're a newbie, the way I would get creative is get your contractor to be on the deal, let him become a responsible borrower, and we would give you the max leverage that we can give the contractor or the experienced person, and working it out between your client, or the client and the contractor, is up to them. If you want to give the contractor 10%, 20% profit, that's up to him. But the way we get creative is bring on a borrower with experience. And by the way, talking about whether it's hard money, 1-4s, mixed use, multifamily, ground up construction, we can mix anybody's money, anybody's experience, and anybody's score. So if your borrower doesn't have any of the above, score, experience, or money, but he's got somebody that's got any of the three or all the three, we will mix it to get the deal done as long as it makes sense. On our DSCR, so I'm happy to say Express Capital has been a lender for 14 years. And we recently opened up a wholesale channel, which I'm going to get to in a few moments. But talking about the DSCR product, right now it's no, of course, like it's always, no tax returns, no W-2s, no income verification. And a good thing for brokers to know when people tell you that they're going to a bank and I got 6% versus 7%, well, the bank is doing their underwriting under the borrower. They're looking at the tax returns, the W-2s, and the income, whether it's W-2 or tax returns. So a bank is limiting you not to the property income and expenses, which is a debt service. They're limiting you to your own personal income. And another thing, which is not such a great thing to use a bank, is they're going to give you lower leverage, a higher debt service requirement. So when it's a higher debt service requirement, they're going to give you typically a lower leverage. And the most important thing is when you're working with a bank, they're going to fund you under your own name. They are lending the individual. They are not lending the company, the entity, the LLC. What does that do for all borrowers? It opens up a liability risk. So DSCR has great benefits of it's a light doc, 2 to 4 week closing, under a company, under an entity, and whether you're doing a hard money loan, ground up construction, a DSCR, all these financing options never appear on the individual sponsor's credit report. So it never affects their personal income. They can buy a boat, plane, car, get credit cards, whatever they want to do. All these mortgages or loans never affect their personal lifestyle. Our DSCR requirement is as low as 0.75. I'm happy to say that we can now offer up to 85% leverage on a single family home only, which is very rare. Typical lenders do 80%. We could do 85% on a single family home, which is a 1 unit. Otherwise, 80% on a 2 to 4 unit. 75 is the max cash out that we could do. This is credit driven. So 660 would be the minimum FICO score. And like I said, only closing in an entity. However, if you have a borrower that needs to close under an individual, we can do it. It would just be under my Express Capital Financing retail option or channel instead of the OLV Olive wholesale channel. Many flexible prepay options, like I said before, from 0 to 1% from 1 year to 5% over 5 years. The higher the prepay, the lower the rate, and the lower the prepay, the higher the rate. Typical turnaround time, by the way, to close on a DSCR, 3 to 4 weeks, I am happy to say that I heard from my team. We did close a deal in 2 weeks on a debt service coverage ratio. So when you're getting on the phone with us or a conversation, email, phone call, text, and you're telling us the pain points of what your borrower needs and wants, we are going to try to meet that, whether it's time sensitive to close, whether it's rate sensitive, leverage sensitive, whatever it may be. But below 75 to 10, with the right credit and down payment, we could still work with you. Why borrowers love it? Self-employed, full-time investors, can't show the income, can't show the tax returns. That's why a DSCR is so popular. On the broker angle, like I said, you're going to be getting a pricing engine. You can price it out all yourself, and the engine portal will give you proof of funds, will give you actual term sheets. The funding is in your name, not Express Capital, not in the Olive OLV name. It's only in your name. On the portfolio side, that again, 2+ properties. We just want to do each portfolio loan in tens. So what's the convenience of it? You're going to have one loan, one payment, one closing. It's a blended LTV across the portfolio. Some of your properties, so if your borrower's got 10 properties, some of those properties may have a great debt service, and some of the weaker properties may have a low debt service. So that's why a portfolio may not always be the best fit for every borrower. Working with my company, Express Capital, we're gonna dissect the deal and letting you know it's best to do 5 separate deals, or let's do a portfolio. Or maybe out of your 10 properties, maybe we'll do 5 of them on a portfolio and 5 separate. The reason why? Because maybe some of those low properties, low values, low debt service could be hurting the other high qualified properties. So it's great for ideal investors that are scaling and building. It's the same type of product. It's a DSCR, same rates, same leverage, same 30-year or a same 30-year fixed, or you could take a 10-year interest only with a 40-year amortization. The benefits, if they do decide and it works out best for them, it's one payment, one loan, one underwriting. So that is that is an honest benefit. Talking about the multifamily mixed use bridge. So to lenders, anything that's over 5 doors is considered a multifamily. We have no cap on the amount of doors, but what we do have a cap on is the door loan, with the door unit count minimum. Meaning we want, if you have 50 doors, we want each door to be worth $50,000. So if you have 50 doors, we want that value to be at least $2.5 million. So we want each door or each unit to be worth $50,000. Minimum loan amount on the initial, when I say initial, day one on the loan to close, we want to have a 250 minimum loan amount. But just to recap, we can go up to 75% of the acquisition, 100% of the rehab, 12 months up to 36, interest only, no prepayment penalties whatsoever. What it's great for, repositioning, stabilizing, then exit, either way. So whether they want to buy, fix, and keep, or whether they want to buy, fix, and sell. So the standard relationship. You bring the deal to us, we process and underwrite it, we close the loan, you can add points. That is a turnkey lender. We do all the heavy lifting, full support the entire way. We call that, the so we on the wholesale side, we got like 3 levels: a tier 1, tier 2, and tier 3. If you're looking for us to do everything for your borrower, sell them, close it, and take care of everything, that to us is a tier 3. We could do that. A tier 1 is a brokerage firm that's got a process, it's got a team below you, you got processing team, you know how to sell it, you know how to close it, you know how to use the portal and price it out. You're going to get better pricing with that. Not so bad. It's only a quarter, 40 bips, 50 bips difference. It's not like it's going to go from 6 to 8. It's a quarter to 50 bips, but that comes with, again, volume and a brokerage firm that knows what they're doing, that can handle the flow and just submit the deals and refund it. The good thing is We close it in a generic name. The borrower never sees ECF. They'll see your shop, your deal. So OLV, which we call Olive, is lane 2. Like I said before, this is the wholesale branch. 0 points to us as a lender. You as a broker will make all the points. You have direct access to make yield spread anywhere from 1/4 to 3% yield spread. You'll have access to our live engine 24/7. You process the deal, structure it, docs, appraisal, credit. If you're doing everything, that to us is a tier 1 broker. You will get not only the access, you're going to get, special pricing 1/4 to 50 bips less. Some brokers just want to submit the deal. They want us to sell it. They want us to close it. You order title, appraisal, and all that. That to us is heavy lifting. That'll be a tier 3 broker. Tier 2 is in the middle of the road. It's just at the middle of the road. Just to, maybe there may be 1/4. And as far as workmanship, we'll have to have a conversation. Maybe half the work will be you, half the work will be us. It's a conversation. We stride ourselves on building relationships. I don't want to make a one-off deal with a client. I don't want to make a one-off deal with a broker. We stride ourselves in relationships. It's a two-way street. You guys got to be happy. We got to be happy to bring in the business. That's what we're all about. So doing it tier 2, it's going to close in a generic name. The borrower never sees Olive or ECF, but they will see a generic name, and that generic name is called Investor Fund LLC. So tier 1, it's your name. Tier 2 or tier 1, it's going to be in a generic name under Investor Fund LLC. But the good thing is we do mostly heavy living, if not all of it or half of it, but your borrower will still never know of us, and you can even say that you are Investor Fund LLC. Where the volume is going? Well, if you look at the left, 40, 46, and 53. Fortunately and unfortunately, about 90% increase year over year is happening, not just with us, with most lenders out there, that they're originating more DSCR than they are hard money or bridge. It's not going anywhere, and it's not gonna dissipate, because there's always a need for properties to buy and rehabilitate. There's always a need for that, and everybody needs a place to live. But the good thing, unfortunately, due to the tightening market, which I'll get to in a few moments, borrowers are feeling the need, instead of selling it and having a smaller profit than the usual and paying capital gains on their profit, they're seeing it's best to be a landlord, not have capital gains, get out 75% on a refi after 3 months. And by the way, talking about that, our seasoning period is 3 months, not 6 months like most lenders are. Right now, the rates in the 2026, it's up and down. So it's around the sub 7s. As of today, our par rate is like 6.75. It doesn't mean you're going to get 6.75. It's just a par rate. Once you have some hits, whether it's the city or state, the credit, the LTV requirements, you're going to be somewhere in that high 6s, possibly low 7s. But there's way to also get down the rate, which is maybe lower leverage. Maybe don't take a yield spread. Maybe take a shorter term, maybe take a higher prepay, and you could also buy down the rate with us. So there's many options for your borrowers to work with us on the DSCR platform and product and program. Why the market is shifting? So banks are pulling back, slower approvals, stricter income docs. DSCR qualifies strictly on the cash flow. And like I said, 10 to 20 days to close definitely could happen. What we say always to our borrowers on the retail level, 3 to 4 weeks, but I'm happy to say that we did close a deal in about 2 weeks, a few weeks ago. So if the borrower needs to close in 10, 20, 25 days, we can make it happen for a rush. But why is DSCR surging? Because of a tighter inventory is pushing more households into renting. And we all know that there's an affordability issue. So when people can't afford to buy, they're forced to rent. That is helping the way the DSCR to get better, because somewhat, in some states, rents are increasing because there's a low demand for purchases due to the market shifting. And another reason also is, even though the inventory is growing slightly higher, we want to have a 6 month of inventory supply. I believe now we're at a 4.5, which is not bad. A few years ago we were at a 2, so it is getting better. But when there's a tighter market of inventory and affordability issues, well, renting is becoming a better option. And that's why investors, instead of doing a fix and a flip, they're seeing it's more advantageous and more fruitful and more income and a portfolio of real estate to build if they're doing a DSCR. Institutional capital made it a liquid asset class, meaning it's becoming very liquid. There's a lot of institutional money from Wall Street that's pouring the money into us DSCR lenders. So that's a great thing to know. And, fortunately or unfortunately, a lot of QM lenders are going into the space also because they're seeing that the market is shifting. On the right side, the flip and ground up construction is kind of cooled. The exit strategy is kind of tightening. And like I said, why? The margins got tighter. The profits average nationwide on a fix and flip from 2024 or even 2023 was anywhere from about 65,000 to about 105. Now it got tighter. Why? Because cost of materials went up, labor went up, everything has gone up, and even the purchase prices have gone up. So the tightening on the spreads on a flip has gotten more tighter, constricted. So that's where fix and flips are, not the, how would I say it to you, it's not such a great exit anymore, just flipping. But it's still growing 28% year over year. And like I said, it's never going to go away. There are many, many properties out there, whether they're old, whether it's in pre-foreclosure, foreclosure, divorce situations, tax liens, things like that. There are always distressed properties. They're always going to be there. And it's an asset class of 1 to 4 that everybody needs to own and have. So the smarter broker plays both lanes. The bottom line, the volume is moving moving the borrowers into the DSCR. This is exactly what our wholesale platform is built for. Why this matters to you. So we could finance, I call myself the Costco of real estate financing, one-stop shop. Your borrowers, whether you're a retail borrower, whether you're a broker, one-stop shop. So we could do the short term, we could do the permanent, we could do the ground up. And if any of your borrowers are using us for hard money and they're going to use us for the permanent, we will save them some dollars on the underwriting cost when they're becoming a repeat borrower. So again, if your borrowers are using us for the hard money bridge, whether it's a 1 to 4, mixed use, or multifamily, and then you're calling us back and saying, hey, put these guys into a perm, we will knock off some dollars on the underwriting on the new loan because that's a repeat customer on the same deal. Just to recap, on the bottom left, your client, your relationship, you are totally protected. We will never call the borrower. So you're in complete control of every which way. On the right side, 2 ways to earn points, yield spread. As far as fees are concerned, right now, we charge on the wholesale DSCR, we have a flat $1,495. That consists of underwriting, doc, prep, and commitment. That number again is $1,495. If you want to charge up to the same amount, that's fine. Some brokers don't like to. They want to make more in yield spread or points, but you have the capacity to charge up to $1,495 as long as you don't exceed us. Speed and certainty of execution to close. Like I said, it's your reputation. You're protected, but we're a lender that excels in certainty of execution to close. So when your borrowers are talking about rate, I like to tell them, look, you need to close in 2 weeks or 3 weeks. We're here. We're going to get it funded. If it's a quarter higher, what's the difference versus a lender that may get you a quarter lower when you may not even get the deal closed on time? And that's where you lose relationships with your seller, the realtor, or however way the property is being sourced from. So most lenders give you a product. We give you a path to grow your brokerage business. If any brokers want to have a Zoom meeting one-on-one with us and you as the owner of the brokerage firm, or you want to have us and your sales team going over the products, the programs, to have confidence in the product, knowing how to sell it, close it, we're definitely open to that. We do that as well. So I just want to give you some gamut on that. And you could become approved broker, standard lane or wholesale lane. But to us, standard is, again, retail. That's not tier 1, 2, or 3. That's just strictly retail, where a broker just gives us a deal and we're doing everything. Will be points, the broker will be points, but as long as the client's happy, we're fine. But some brokers want, they have the volume, they have the capacity with loan officers and underwriters and processors where we don't have to do anything but underwrite it and fund it. That's a tier one broker. And again, a tier two broker is 50% of the work we'll do and they'll do. And then a tier three is we're kind of doing everything, but there's volume there. So it really just depends on what type of relationship do you want and what kind of volume can you bring in. And I just want to recap one thing before I, end this and take some questions. The difference of pricing between a wholesale level of rate to a retail level, the max it would be is 50 bips. So it's not, it sounds like a lot, but it's not a lot. Some brokers would rather charge their customers 7% versus 6.5, and we handle everything. But some brokers, have the time and the patience and the know-how to do everything. No worries. We could do either one. So that is my presentation for today on our products, programs, who we are, and what we are. And I'm happy to say, before I take questions, we're number 3 on Forbes, 3 years in a row, which brings us a lot of credibility and service. We're also on Scotsman's Guide and also on Bigger Pockets. I believe number 10 as far as a lender and service and certainty of execution. So that's something that I'm very proud of. I like to share, and these are good reasons why to choose us. Because you may be shopping for the best rate, but you need to shop for service, communication, and as well as easiness and transparency.
That was great, Mark. Thank you. I appreciate it. There is a couple of questions out there. Darrell, are you available, sir?
Yes,
You're on
I am
mute.
here.
There you go. Go right ahead, sir.
Thanks, Martin. I appreciate that. The client experience is paramount. When you already, I think you answered the question about the multifamily ground up limit. You wanted 50,000 per unit at total value once it's completed, if I understand that correctly.
So let me just correct you. No, from the onset, we want 50,000 minimum on the as-is value.
On the as-is value. Got it. Okay. Thank you for the clarification.
No worries.
And then regarding the time frame on the contractor experience or borrower or responsible party experience, which documents are you looking for to prove that they've completed a deal? Is it a HUD or what's the easiest way to get that documentation to you, and what are you looking for?
So it's a track record. If you don't have one, I can send you one if you send me your email, I guess, after this webinar. But it's a track record. It's a very common thing. And by the way, they could take a track record from their previous lender. It doesn't have to be my template, but it's a track record. And then my underwriting team, goes into a very quick analysis.
Got it.
Okay.
So reach out to you on LinkedIn or this info at Express Capital Finance.
You can direct it to me. I'll give you my personal email. It's Martin, Martin at Express Capital Financing, not finance. It's financing.com. Introduce yourself. Tell me what you need and want. I'll be glad to give it to you. But track record could be any template. And I want to add something also, like I said, on either of my products, any of my products, which is not in the presentation. We only do soft pulls. So anytime we pull a credit, it'll never show on their credit report, and any of my mortgages will never show up on the credit report unless, God forbid, they default.
Great. Thanks, Darrell. Larry Grant, are you out there, sir? Hold on for a second. Larry's question, currently, what do you see most brokers making, tier 2 or tier 3, point-wise, including yield spread? What's the general range?
It's a loaded question. Some brokers charge 3 and no yield spread. Some are smart and they charge, 1.5 points and some yield spread. But I like the brokers that are not greedy and they'd rather take something versus nothing. So those are the brokers that are smart, acclimated, and they're not only hungry for their income, but they care about their client. Because when brokers, charge 3 points and then 3 yield spread, it's fine. We could do it. but are we, sometimes the client's going to say no and you lost the deal.
Gotcha. Larry, I hope that answered your question, sir.
Yeah, thank you very much.
No worries. And by the way,
Okay.
if you need some insight on a deal, if you're submitting it to us and you call us up and say, guys, what do you think I should offer here? We're happy to, give you suggestions.
Excellent. All right, great. Listen,